Yeah, let's get started with this alternate investments, which forms just 3% weightage for our exam. And there's a lot of downsizing that has happened in this syllabus compared to your 2012, where there was a lot of focus on calculation aspects relating to venture capitals and real estates, but they are all now pushed towards the level 2. So all these things only from a conceptual standpoint are what are covered for your level 1 curriculum this year. Now, just to understand the difference between what we categorize as a traditional investment versus an alternative investment. So whenever we talk about direct investments, where majorly it's a long position, I buy something and then sell. That's a traditional investment mechanism. Long positions, stocks, bonds, or maintain it in the form of cash or FDs. These are typically the traditional type of investment. Whereas if I add them up with various other mechanisms like real estates, commodities, venture capitals, private equities, or any such kind of hedge funds, equity funds, any of these kind of stuff, even in the real estate, not just as a property, we have seen mortgage backed securities. So, wherever the investments are happening, not in the traditional stocks and bonds, not in the traditional stocks and bonds, we are categorizing them as the alternate investments. Even the exchange traded funds, mutual funds, even mutual funds also go slightly into the category of alternate itself. But though they are a mix of, if they are a mix of stocks and bonds, then they are still a traditional mutual fund. But today the mutual funds are even going beyond the typical stocks and bonds and investing in various other kind of securities also, in real estates, in commodities. So that's where the focus is moving more towards alternative investment mechanism. Though the typical role of a CFA is heavily driven into the traditional investments mechanism itself, but it's not fully into traditional investments. Even he has to have a considerable amount of understanding towards the mechanisms of alternative investments also, because a CFA at the end is responsible for building a well-defined portfolio and managing a well-defined portfolio. So it may require getting into various alternative modes of investments also. So that's where there is some kind of introduction at least into all these various alternative investment mechanisms. So why are alternative investments preferred, or what are the advantages or disadvantages associated with the alternative investments when you compare them with the traditional investments? Obviously they have low liquidity. Probably you could take it with your real estate example. The stocks today I can buy, tomorrow I can sell, but that may not be the case with my land or property, right? Or any commodity. Some commodities, yes, gold kind of commodities I can buy today, sell tomorrow kind of stuff. But lot of other commodities, they don't have that much of liquidity. But at the same time, they have less regulations, at least compared to what a stock market where the disclosures have to be done. SEBI is completely behind in terms of every element of the financial statement to be informed to the investors and all that. When it comes to the markets like hedge funds and all, the regulations are not that heavy when we compare it with the typical stock and bond market. So they are less regulated, and they have a higher management fees, because it's more about the entire worthiness of investment in that fund depends on the manager of that particular fund. How well is he able to play around with the scenarios by having an in-depth understanding of the underlying markets. So that is where management fee as well as the incentives would be much higher in these kind of products compared to a traditional investment products. And management has to be more specialized, and they offer potential diversification benefit. People have observed that probably the commodities market, investing in a commodities market, is a hedge against inflation. Right? The same may not be the case with the stock market. Why we are saying a hedge against inflation? The typical method of calculating the inflation itself will include so many commodities inside that. So an increase, if the inflation is high, it means the price of most of the commodities will go up. If I have taken a short position on those commodities, I would have gained very heavily, right? Or if I'm taking a long futures position on the commodities, I would have gained very heavily. Correct? If the price of the commodities are going to go up, I have already taken a long futures position at a very lesser price. I am gaining that difference, right? So they offer proper diversification benefits also, and it is clearly observed over the past few years also that stock markets and commodity markets tend to behave in opposite directions, because at the end it's the same set of people, right? If they are buying in stocks, they buy less in commodities. If they are buying more in commodities, they buy less in stocks. So the behavior wise, it is found that they are slightly less correlated or more negatively correlated than positively correlated. So that itself will offer a potential diversification or a portfolio kind of a benefit. And most of these are traded only in the futures markets and all, which means there is a scope for using heavy leverage. And most of them are traded through derivatives. Leverage is almost with very less of your amount, you are trading in very large positions. In an option, I just need to pay a very small premium, but I am trading in big lot sizes by just paying very small amount. So they use heavily in derivatives, and there is a chance that you can make very high returns, but at the same time there is a chance that you will lose also. And I cannot make much of a judgment based on the historical data for this, because it's not a traditional movement. Sometimes there could be a very vast growth, sometimes there could be a fall, right? Because they are dependent on various other factors. Let's say we talk about agricultural commodities, heavily dependent on monsoons and various other aspects rather than just the price movements, rather than just the psychology of behavior of the investor. These are more driven by various other factors. Whereas when we talk about a traditional stock market, by understanding the psychology of the investor, we can very well try to use technical analysis to make our buy-sell patterns. Whereas when it comes to commodities, just alone a technical analysis may not be sufficient, right? And so the historical data, analyzing it, processing it heavily may or may not be of extraordinary importance when it comes to the alternate investments. And of course, legal wise, tax wise, there are so many other complications compared to a traditional kind of investment. So that's where when we are trying to invest in alternate investment mechanism, the pattern is entirely different from we trying to invest in a traditional mechanism itself. So now there are four major instruments that are discussed for us. One is the hedge funds, two is private equity, the funds involving the private equities, and three being real estate, four being commodities. So these are the four major categories that are touched upon, though you can talk about various other investments also as a part of alternate investment, but here the focus is on these four broad bigger category of financial instruments which fall under the category of alternate investment. Now when we talk about hedge funds, hedging itself is reducing the risk. A fund is created. Again, all the funds behave in the same way. We have discussed even in our mutual funds chapter long back in portfolio management. Whenever we talk about the word fund, it's nothing but pooling of money from various resources. Now, depending on where this pooled money is invested, the fund is given that name. When I say hedge fund, this pooled money is invested in less risky instruments, but Here less risky does not mean safe instruments. Here less risky means I'll invest in a risky investment, but use some other mechanism to reduce the risk. Right? It's not that they are depositing it in bank deposits. I mean, if I have to make things simpler, when I say less risky investment, probably a bank deposit or a FD would be the simpler thing. Then why should these guys do an FD deposits for us? But the simple way to understand it is, these guys' objective is to generate an arbitrage profit, which is a return in excess of risk-free rate of return with zero risk. Logically speaking, if it is zero risk, I should get only risk-free rate of return. Right? Zero risk, we have been talking about it. The return that comes with a zero risk is the risk-free rate of return. But these guys, the hedge fund managers, they are packaging multiple products in such a way that their risk will become zero, but they will generate a return which is in excess of the risk-free rate of return. If the risk-free rate of return is 8%, their objective is to generate 10% return with the same zero risk. Now, if that's the case, they have an arbitrage profit because there is one instrument, zero risk, 8% return. There is one zero risk, 10% return. Sell this, buy this, sell this, buy this. Huge volumes. So they play on heavy volumes on that 2%. If they can identify an instrument in such a way that the risk is zero, but still it generates some extra return, which is more than the risk-free rate of return, the difference is their effort. And they try to maximize the volume using that combination, which will create huge profits. So that's where what happens with respect to hedge funds is heavy leverage is required. Heavy investments are required, because if I have to create this kind of a position, I have to buy heavily here and sell heavily here, right? So the heavy leverage is getting created in the process. So as long as things are fine, they'll make huge profits. But the moment they are not, their estimation about zero risk is wrong, they'll get into unlimited losses. So that's the typical problem associated with the hedge fund. So that's where they limit the number of participants in the hedge fund. It's completely unregulated kind of a market, or very little regulated kind of an instrument. So that's where only high net worth individuals will enter into that hedge fund kind of investment. So probably each person's investment will not be anything less than $1 million. Person who is investing in a hedge fund, the minimum, and even the fund manager himself will put that kind of a restriction. At least $500,000 or at least $1 million should be the minimum investment for someone who wants to invest into a hedge fund, because they will not pool the money from multiple people. Again, there is a restriction that they cannot pool money from more than 500 participants. So if from 500 people they have to generate so much of money, because for identifying the opportunities and all, it's a big task. So if they have to spend so much of money and only from 500 people, then from each person the pool has to be a very huge pool. And that's where hedge funds are restricted only to a limited set of investors, but who are ready to contribute very heavy amounts into that. So some key characteristics wise, they always believe in long and short positions. Means probably either everything that contributes to arbitrage. They buy in one market, sell in other market. Probably yesterday I have created that position. Buy in the derivatives market and short in the stock market, right? Because there is a kind of a mispricing that is found, right? So they will always try to identify these kind of mispricings, and they always place a long and short positions to a large extent, or probably in the stock markets itself, buy on NSE, sell on BSE, or any other strategies like that. See, when you are saying a buy, your risk is some x. When you are selling, your risk is minus x. X and minus x, overall risk is 0. Because overall risk is nothing but, or probably when we say the beta of the same security, beta of a security is some x. Right? Now when I am buying it, that beta is the risk. When I am selling it, minus beta is the risk. So when I am forming a portfolio, it's a weighted average. W1 beta minus W1 beta, which is making my risk to be 0 itself. I am buying the same security, selling the same security. If it is the same security, its beta should be the same. But I will see what is the return that it is generating. If it generates a return more than the risk-free rate of return, done. Right? So they always believe in long and short position. They don't mind using derivatives, whereas most of the traditional investments, whether it is mutual funds, if we talk about traditional mutual funds which invest only in stocks and bonds, they don't use derivatives at all. They are banned from using derivatives, especially the shortings. The shortings and usage of derivatives, there's a big limitation in the as per the mutual funds regulations also. You can only buy and sell the securities, but not use the derivatives for that in the traditional mutual funds investment. Whereas when it comes to hedge funds kind of thing, the hedge fund manager is having, because mutual funds are more regulated compared to the hedge funds. So as the hedge fund manager, you are free to invest wherever you want. You are free to short whatever you want. It's completely a privatized kind of an investment mechanism. So that's where they use heavily the derivatives. And the moment they are using derivatives, it's becoming huge leverage, because they have to take positions on huge lots by paying small margin deposits or the premiums. If it is in case of futures, they'll go with the margins, which is again 5 to 10% of the total contract value. Or in some cases, they'll go with, in options case, they have to go with premiums, which is again depending on if it is an OTM kind of an option, the premium will be very, very minute. Right? So from those standpoint, they are creating huge leverage positions. And when it comes to private equity funds, majorly two categories. One is venture capital, or two is buying out some existing firms, putting equity investments in some existing firms or new businesses. So already established businesses, take some stake in them. That is one model of private equity. The second model of private equity is invest in new businesses, which is nothing but venture capital. So again, earlier it used to be the scenario where one person used to invest in all these things. They are all risky investments. Today there are funds even doing the same stuff, which is a pool of all investors pulling together. That pooled money is invested either in new businesses, which are called as venture capital funds, or in buying out stakes of some established companies, which are called as private equity funds. Right? So these are so typically when we are looking at a normal traditional private equity kind of funds, we are looking at companies who want to become private from public. So what would be done for them is, I'll buy out the equity stake of that company. Using my money, using this fund, I'll buy out the equity stake of that fund.